Meta just posted a massive Q2 2026 revenue beat of $60.8 billion. Yet, the stock immediately tanked 4.2% after hours. Why? Well, because underneath that incredible top-line growth is a staggering $145 billion AI gamble that is significantly compressing their profits. What you're about to hear is the real story of what is actually happening inside Meta right now. This is a company fighting a war on two fronts. On one side, we have an unstoppable, highly profitable advertising machine. And on the other, it's violently colliding with an unprecedented, historic capital expenditure cycle to control the future of artificial intelligence. We're going to break down the exact math, the hidden risks, and why the market might be fundamentally misunderstanding Meta's valuation.
Look, the central conflict is obvious right out of the gate. On one hand, you have absolute operational dominance. Q2 2026 revenue grew 28% year-over-year to nearly $61 billion. But at the exact same time, free cash flow literally plummeted from $8.55 billion a year ago all the way down to just $784 million. That is a shocking collapse in cash flow for a business of this scale, and it creates this massive curiosity gap about where exactly all this cash is going. To really understand the tension here, we first have to ground ourselves in what Meta actually is today. It's a global digital communication and advertising infrastructure platform. 98% of their revenue comes from programmatic digital advertising delivered across their family of apps. So Facebook, Instagram, Messenger, WhatsApp, Threads. And their primary customers aren't just massive global brands. They're millions of micro enterprises who choose Meta for its superior social conversion rates.
And those conversion rates, they are driven by one specific number, 3.6 billion. That's Meta's daily active people metric. Over 3.5 billion human beings check these apps every single day. Because of this totally impregnable network effect, users stay for their social circles, and advertisers are effectively forced to allocate their budgets here. You simply cannot find this scale of highly targeted programmatic audience reach on legacy print, linear television, or even smaller digital networks. So when they're competing against legacy social media like Snap or giants like Alphabet and Amazon, Meta holds its ground by deploying massive capital into sophisticated AI recommendation engines that keep users scrolling and ultimately keep advertisers paying.
But attention only matters if it turns into money, right? The primary business drivers for Meta are expanding ad impressions and increasing the average price per ad. And the way they're doing this is through their automated ad suite called Advantage Plus. A staggering 82% of Meta's advertiser base is now utilizing these automated tools. This isn't just a neat little feature, it is a $60 billion annualized run rate juggernaut, and it creates heavy switching costs for advertisers. Small and medium-sized businesses have deeply integrated Meta's ad bidding interfaces, conversion tracking codes, and generative AI asset systems directly into their daily operations. Leaving Meta to go figure out another platform is logistically and financially painful. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
Section 1. The Capital Chasm, where $60 billion goes to die.
So, let's pivot to the core conflict driving the narrative right now, which is Meta's unprecedented capital expenditure guidance. Management recently raised and narrowed their full-year 2026 capital expenditures to between $130 and $145 billion. The market is frankly terrified that overbuilding data center capacity to support all these AI initiatives will burden the company with heavy fixed depreciation costs, depressing their operating margins for years to come. If we look at the Q2 2026 earnings released on July 29, 2026, you can see a severe divide inside the company. The family of apps is a pure profit engine, generating over $23 billion in operating income for the quarter. But Reality Labs, Meta's spatial computing and hardware division, operates as a $4.6 billion quarterly black hole. Cumulatively, historical losses here have now topped $90 billion. This structural divide is heavily impacting the bottom line. Despite that massive revenue beat we talked about, Meta actually missed diluted earnings per share consensus estimates of $7.17 by nearly a full dollar, coming in at just $6.18.
Now, management knows the market is anxious about this. During the earnings call, founder and CEO Mark Zuckerberg really emphasized that their AI infrastructure investments are already showing clear returns through better ad performance and user recommendations. But CFO Susan Li provided this critical context, noting that the aggressive spend is being pushed even higher by skyrocketing memory chip costs. To offset this over the long term, Meta is aggressively deploying over 1 gigawatt of its own custom MTIA silicon, developed with Broadcom, to supplement their NVIDIA and AMD systems. But right now, the cash burn is intense. That free cash flow number dropping down to $784 million happened because Meta spent over $31 billion on capital expenditures in just a single quarter.
But look, it's not all just burning cash in a data center. There is tangible hardware success happening here. They have effectively captured total market dominance in spatial computing, holding nearly 76% of the XR device market in 2025. And this isn't just driven by bulky VR headsets anymore. The Ray-Ban Meta AI smart glasses have emerged as a vast strategic victory. They shipped 6.5 million units in 2025 alone and generated over $2 billion in revenue, officially surpassing Quest headset sales for the very first time. They are building the next computing platform, and right now, they are absolutely winning it.
Synthesizing all of this, the qualitative scorecard derived directly from the research gives Meta a blended score of 7.7 out of 10. But look at the extremes here. Profitability and market position are both sitting at a 9. Meta prints elite margins relative to global software peers, boasting a historical last 12 months gross profit margin of nearly 82%. But then, management alignment sits at a 6. Mark Zuckerberg holds nearly 100% of the Class B common stock. This grants him approximately 61% of the overall voting power, despite holding only a 14% economic stake in the company. As a public shareholder, you have virtually zero ability to influence capital allocation, which brings us to the lowest score on the board, a 5 for capital allocation, reflecting the massive risks of that $145 billion gamble.
By the way, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash does have a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. You also get Portfolio Watch, which monitors your portfolio and flags important changes, plus Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or just access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's apply all this fundamental research into a mathematical framework. Before we start, I must clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. We're modeling a 5-year horizon out to 2031, anchored on a trailing 12-month revenue base of $208.24 billion and a current after-hours share price of $560.85.
Let's walk through the base case first, which the research assigns a 55% subjective probability. In this scenario, the programmatic advertising engine remains structurally sound. The monetization of Reels converges with feed economics, and that custom MTI silicon actually starts offsetting those heavy incremental hardware costs. Revenue compounds at a 13% annual growth rate, right in line with structural market growth, pushing year 5 revenue to over $420 billion. Crucially, net margins stabilize at 30%. The market rewards this stable operational performance and assigns an exit PES multiple of 20x. Factoring in active share repurchases, reducing the share count, this yields a year 5 implied share price of $1,071.32. That represents an annualized return of 13.82%.
But what if the market's fears are completely justified? This is the low case, carrying a 25% probability. Here, we assume a sharp deceleration in global digital advertising demand compounded by structural data privacy changes. Revenue growth slows to just an 8% CAGR, reaching $335 billion in year 5. Operationally, the $145 billion Capex bet goes wrong. Meta finds itself burdened with high fixed depreciation from overbuilt GPU clusters, dragging net margins down to 25%. Because free cash flow is compressed, share repurchases slow to a crawl. The market views Meta as a low-growth, capital-intensive utility, compressing the exit PE multiple to just 16x. The implied share price drops to $541.53, yielding a negative total return over the next 5 years. And finally, let's lay out the high case, with a 20% probability. This is where Zuckerberg's immense gamble pays off spectacularly. Meta achieves dominant commercial success in agentic AI services, creating a parallel, high-margin B2B software revenue stream through WhatsApp messaging, while consumer wearables like the Ray-Bans experience exponential adoption. Revenue compounds at a highly optimistic 18% CAGR, crossing $500 billion by year 5. As Reality Labs achieves scale and capital expenditure tapers off, net margins expand to 35%. Robust cash flows fund aggressive buybacks, pushing diluted EPS over $81. The market re-rates Meta as a premier AI and hardware growth leader, assigning a 24x multiple. The implied share price here, $1,959.86, an annualized return of over 28%. If you want to see the full model with all the detailed line item assumptions for each of these scenarios, you can access the full research report at flash.stocksentinel.ai. So, when we take those three potential futures and multiply their year 5 implied share prices by their respective probabilities, we arrive at this number, a probability-weighted 5-year target price of $1,116.58. Contrast that with the current stock price of roughly $560. Meta's trailing 12-month EPS currently stands at $26.55, giving it a trailing PE of just 21.12x. The forward PE is even lower at 18.81x. To put that into perspective, the market is pricing Meta as an infrastructure-heavy hybrid right now, not a pure software compounder. If their margins hold, this might represent a deep, asymmetric valuation opportunity. Section 2. The existential choke points. What could break the thesis?
Now, margin compression from capital expenditure isn't the only thing that could permanently impair this bullish setup. Beyond the data centers, Meta faces a hostile legal environment. The immediate existential threat is an August 18, 2026 multi-state trial targeting their core algorithms, specifically things like the infinite scroll. If those engagement algorithms are forcibly altered, it literally breaks their monetization model. Add to this an escalating $83.66 billion in long-term debt to fund all this Capex, and the constant threat of cross-border e-commerce tariffs that could wipe out billions in high-margin revenue overnight.
So, what should you actually be watching for to know if the thesis is breaking? The research outlines specific early warning signs. If you see consecutive sequential declines in daily active people or a sharp drop in international average price per ad, the underlying thesis is fracturing. Another massive red flag would be a plateau in the annualized revenue of the Advantage Plus suite, which would suggest that advertiser adoption has fully saturated. If you see those signs combined with a multi-year margin contraction below 30%, it pretty much confirms the $145 billion Capex budget is failing to drive incremental revenue.
Okay, let's bring this all together. First, the entire story of Meta right now is defined by the tension between an unstoppable $60 billion programmatic ad engine violently colliding with an unprecedented $145 billion AI infrastructure spend. That spend is compressing near-term free cash flow. Second, because the market is hyper-focused on the Reality Labs cash burn and the data center depreciation, the stock is trading at an implied trailing PE that may present a deep asymmetric valuation opportunity, but only if management can stabilize those operating margins at 30%. And third, the critical catalyst to watch next isn't just AI chips. It's the August 2026 multi-state legal trial that threatens the very engagement algorithms that make Meta so profitable in the first place. The stock tanked 4.2% after a huge revenue beat because Wall Street simply does not know the answer to this question yet. Mark Zuckerberg is betting the entire free cash flow of the world's greatest advertising machine on dominating the spatial computing and AI future. He already has 75% of the hardware market to show for it, but the cost is historic. Will this $145 billion gamble cement Meta's monopoly for the next century, or will it permanently break its margins? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.